For 6 years running, one magazine named this the most innovative company in America, not a tech startup, an energy company out of Houston, Texas. By the year 2000, it was the seventh largest corporation in the United States. Bankers chased its business schools taught its strategy, and its stock only ever seemed to go up. There was just one problem with the most innovative company in America. A great deal of the profit it reported had never actually happened. The company was called Enron, and its real innovation was not in energy at all. It was in accounting, a way to report money it merely hoped to earn someday, as though it had already earned it, and to hide the mountain of debt that hope was built on inside other companies it secretly controlled. For years, that machine made almost everyone rich. Then somebody asked the one question it could not survive: where is the actual cash? When the answer finally came, the seventh largest company in America was gone in under a year, and about $74 billion of shareholder value went with it. This is exactly how the trick worked. And by the end, you'll have the one question that could have caught it years earlier, a question that still works on any company today. Enron began as something boring and completely real. A natural gas pipeline company, formed in 1985, run by a genial Texan named Kenneth Lay. Pipelines are about as unglamorous as business gets. They also make steady, unspectacular money. For a while, that was Enron, solid and a little dull. Then, in 1990, Lay hired a consultant named Jeffrey Skilling, and Skilling had an idea that would remake the company and eventually American business itself. Why own the pipelines at all? Why own anything heavy and expensive? Enron, he argued, should stop acting like an oil company and start acting like a bank for energy. It would buy and sell gas and electricity the way a bank trades money, matching buyers to sellers and taking a slice in the middle. And here's the part people forget. It was a genuinely brilliant idea. Enron built a whole market where barely one had existed before. For a time, the trading business was real and really profitable. The problem was never the idea. The problem was what Skilling needed to do to the accounting to make the idea look even better than it already was. Because Wall Street had fallen in love, and love on Wall Street is a demand. Every quarter, Enron had to be more dazzling than the last. A merely good quarter would sink the stock, and everyone's pay, from Skilling on down, was tied to that stock. So the pressure was always the same, and always pointed one way. The numbers had to keep going up, whatever it took. Here's the first piece of the machine, and it hides behind a boring name: mark-to-market accounting. Skilling loved it so much that he reportedly threatened to quit unless Enron was allowed to use it. And in 1992, the regulators said yes. Normally, if you sign a 20-year deal to supply gas, you count the money as it actually comes in, a slice each year for 20 years. Mark-to-market let Enron do something stranger. The moment it signed that deal, Enron could estimate how much profit the whole 20 years would eventually make and book every dollar of that estimate right now as profit, today. The profit was a guess about the future. The cash wouldn't arrive for years or decades if it ever arrived at all. But on the books, on the day of signing, that guess counted exactly the same as money in the bank. And who got to decide how big those future profits would be? Enron did. If a deal needed to be worth $200 million to hit this quarter's target, someone could choose the assumptions that made it worth $200 million. It wasn't quite a lie. It was a hope, written down in ink, in the profit column, and shown to the world as a fact. So Enron's reported earnings climbed beautifully, quarter after quarter after quarter. And behind them, a gap quietly opened between the profit Enron announced and the cash Enron actually had. That gap had to be filled with something, or better, hidden somewhere. And that is where the second man walks in. His name was Andrew Fastow, and in 1998 Enron made him Chief Financial Officer, the man in charge of the company's money and its debt. Fastow's job was to solve Skilling's problem. How do you keep reporting soaring profits when the business underneath is actually burning cash and piling up debt? His answer is the cleverest and the most damning part of this whole story. Fastow created other companies, dozens of them, then hundreds, with cryptic little names: LJM, Chuco, the Raptors. On paper, they were separate, independent businesses. In reality, Fastow built them. Fastow ran several of them himself, and they existed to do exactly one thing: deals with Enron. Here's the move, in slow motion, because this is the whole game. Say Enron owned something that was losing money, a bad investment. On Enron's books, that loss is a problem. it drags the profit down. So Enron would simply sell the bad investment to one of Fastow's little companies. And just like that, the loss is gone from Enron's books, replaced by the sale price, recorded as a tidy profit. Except the company that bought the loss was not independent at all. It was funded, in large part, with Enron's own money and Enron's own stock. So Enron was essentially selling its garbage to itself and booking the sale as a profit. It was moving debt out of one pocket and into another pocket it also owned, then calling the empty pocket a success. This is how you make billions of dollars of debt disappear from a balance sheet. Not by paying it off, by parking it in a company you secretly control, just far enough away that the rules said you didn't have to show it. Investors looking at Enron saw a lean, soaring, profitable machine. They were looking at a magic trick. The debt hadn't gone anywhere. It was standing just off stage, in the dark, waiting. And there was a bonus if you happened to be Andrew Fastow, because he ran the little companies that traded with Enron. He could take a cut from both sides of the same deal. He personally made around $45 million from these arrangements. And here's the detail that tells you everything. His own board of directors had voted to waive Enron's conflict of interest rules, specifically so their chief financial officer could do this. The people whose entire job was to stop it looked directly at it and said yes. So by the year 2000, Enron looked spectacular and felt invincible. The stock hit around $90. Skilling and Lay were magazine royalty. But underneath those two machines, the reported profit and the real cash were quietly pulling apart. And cash is the one number that is very hard to fake, because it either arrived or it didn't. In April 2001, on a conference call with Wall Street analysts, one money manager pushed Skilling on exactly this. He pointed out that Enron was the only major company that couldn't seem to produce a basic balance sheet to go along with its earnings. It was a fair, almost boring accounting question. The chief executive of the seventh largest company in America called the man an obscenity, live on the call, and moved on. But sit with what that reaction was covering. The honest answer to where is your balance sheet was hidden inside a maze of secret companies holding debt they'd very much prefer you didn't see. It was easier to insult the man than to answer the question, and a few people had finally started asking that question out loud. Not the regulators, not the auditors, a magazine journalist, a short seller, and one woman still inside the building. In March 2001, a journalist named Bethany McLean published an article in Fortune magazine with a deceptively gentle title, "Is Enron Overpriced?" She hadn't uncovered a secret. She had simply tried to answer an ordinary question: how exactly does this company make its money? And discovered that she couldn't. The public filings didn't explain it. When she asked Skilling directly, he told her the question itself was unethical. She'd been pointed there by a short seller named Jim Chanos, who noticed something odd. The company reported fabulous profits, yet never seemed to generate any actual cash, while its own executives were quietly selling their shares, so Chanos bet against it. But the most dangerous doubter was already inside the building. Her name was Sharon Watkins, an Enron vice president, and in August 2001 she did what the auditors and the board would not. She studied Fastow's structures closely, understood what they actually were, and wrote a memo directly to Chairman Ken Lay, warning that Enron could, in her words, implode in a wave of accounting scandals. She was not thanked. Enron's own lawyers looked into whether she could be fired for raising it, the clearest warning, from the one person senior enough to understand it, and loyal enough to say it out loud, went quietly into a drawer. But by then, it no longer mattered who was willing to listen. Which brings the question these stories always seem to arrive at. None of this was hidden in a back room. Enron's books were audited every single year by one of the most respected accounting firms in the world, Arthur Andersen. Andersen's entire job was to look at these exact numbers and certify to the public that they were true. And every year they signed off. Why? Follow the money, as always. Andersen didn't only audit Enron, it also earned enormous fees consulting for Enron. Tens of millions of dollars a year. The firm that was supposed to be Enron's independent watchdog was at the same time one of its best paid vendors. Independence gets very expensive when the company you're judging also signs your paycheck. And it wasn't only the auditors, the analysts rating the stock, the bankers structuring the deals, the board waving the conflicts through. Almost everyone who could have pulled the alarm was being paid by the very thing they were meant to be watching. And inside the company itself, a culture engineered to punish doubt. Enron ranked its own employees against each other and fired the bottom slice every year. In a place like that, the person who raises his hand to ask, "Wait, is any of this real?" isn't a hero, he's next, so almost nobody asked. In August 2001, right near the top of the market, Jeffrey Skilling abruptly resigned as chief executive after only 6 months in the top job, citing personal reasons. The architect of the whole machine simply walked out and Ken Lay stepped back in to run it. To a lot of people watching, that exit did not look like a man leaving a company that was fine. Because the machine had a flaw wired right into it. Many of Fastow's hidden companies were propped up by Enron's own stock. As long as the stock stayed high, the structures held. But the stock had begun to slide, and as it fell, those hidden companies started to collapse, which forced their losses and their debt back onto Enron's books, in public, all at once. In October 2001, Enron finally had to admit a piece of it. It announced a $600 million quarterly loss and wiped more than $1 billion off its own value in a single stroke, quietly tied to Fastow's partnerships. Weeks later, it restated years of past earnings, erasing hundreds of millions in profit that, it turned out, had never really been there. After that, it was a rout. Regulators opened an investigation. The credit agencies cut Enron's debt to junk, which, under the fine print of its own deals, meant it suddenly owed billions immediately. A rival company agreed to buy it, opened the books to take a look, and fled. On December 2, 2001, Enron filed for bankruptcy. At the time, the largest corporate bankruptcy in American history, around $63 billion in assets gone. The 7th largest company in the country had fallen apart in under a year, from the inside, under the weight of all the debt it had spent a decade pretending it didn't have. The people who paid for it were not, mostly, the executives. Around 20,000 Enron employees lost their jobs, and many their retirement savings, because they'd been encouraged to pack their 401ks with Enron stock, now worth almost nothing. People who'd given a company a working lifetime watched it vanish in weeks, while some at the top had sold their own shares months earlier. Arthur Andersen, the auditor, was caught having shredded tons of Enron documents as investigators closed in. It was convicted of obstruction in 2002, and the 89-year-old firm was destroyed. Tens of thousands of Andersen employees who'd never touched the Enron account lost their jobs too. In a strange final twist, the Supreme Court unanimously overturned that conviction in 2005, far too late. The firm was already gone. The men themselves went to court. Andrew Fastow, the mechanic, pleaded guilty and served 6 years. Jeffrey Skilling and Kenneth Lay were both convicted in 2006 of fraud and conspiracy. Skilling served 14 years, released in 2019. Kenneth Lay never served a single day. He died of a heart attack in July 2006, a few weeks after the verdict, before he was ever sentenced. And because he died before he could appeal, the law erased his conviction entirely, as though it had never happened. Enron did change American business in the end, just not the way the magazine covers meant. The very next year, Congress passed a sweeping accounting reform law, built specifically to make it harder for any company to do quite this again. The most innovative company in America's true legacy was the law written to stop the next one. So here is what Enron actually leaves you with. The reason this is a money villain, and not just a bankruptcy. Bernie Madoff drew a line that never blinked. Enron's tell was quieter, and it's one you can still use today. A company whose reported profits keep soaring, while the actual cash somehow never shows up. Profit is an opinion. It rests on 100 choices about an unknown future. Cash is a fact. It's in the account, or it isn't. When those two drift apart, and stay apart, and the company gets angry the moment you ask why, you are not looking at innovation. You are looking at someone writing down a hope and calling it a fact. Enron called itself the most innovative company in America. And, in a way, it was telling the truth. It had genuinely innovated. A method for reporting money it did not have, and hiding the debt that money was borrowed against, for the better part of a decade, in plain sight, with every professional watchdog paid to stand up and applaud. It could have been undone by anyone willing to ask where the cash actually was. For 10 years, it was simply more profitable for everyone to look at the profit, and never at the cash. Every fact in this story is on the record. The sources are in the description. I'm Vincent, and this was Money Villains. Like, share, and subscribe. Every fortune has a villain. We find them.